Right. And so we know that, Gareth, you're very agile when you're making your trades. You are in and out. You're watching the markets every day. Maybe you could give us an idea of what you're doing, but also, for investors who may not want to be in and out all the time, how can they handle this situation where we're watching a lot of things moving towards some big decisions here?
Yeah. So for people that are just kind of monitoring this market and getting nervous, I mean, remember, cash is a position. And I know no one wants to be in cash with inflation high, but it actually can be a good thing because you can wait patiently for stocks to bottom out. Now, when you're looking to buy investments, right, I would strongly encourage quality names, right? Go to the quality names after they've been hammered. So for instance, for me, I like companies, honestly, like a Netflix here. And in fact, we can look at Facebook and Netflix, but these are two quality names. Facebook is not going anywhere. The ad revenue should be monstrous. You can see it's down at this range, down over 50% from its highs. I have this upsloping trend line just a little bit lower. So, if this were to get down here, I mean, even here at the current levels of 180 is kind of interesting going into earnings, but down here at 165 is also an interesting level. And the reason why I like these is, number one, it's best of breed. So Facebook is best of breed, and it's still a cash cow. I mean, even with things slowing down, people going out because of COVID now, not on Facebook as much, it's still the number one play, and it's discounted massively from where it was. In fact, it's trading back where it was in late 2017 and 2018. So I like those type of names. And then if you look at like a Netflix, everyone's kind of blasting Netflix and saying, oh, it's over. But in reality, Netflix is down from $700 to $200, and it's trading back at levels that it hasn't seen since 2017. And to me, I look at it and say, well, listen, yes, things were going to slow down after COVID because people don't want to be cooped up in their houses anymore, but they're going to see stabilization. They're going to fix a lot of these issues. And when companies are down this much, expectations are rock bottom. So it doesn't take a lot for them to come out and say, hey, we're going to do this one tweak. And all of a sudden, the stock can rally 10 or 15 or 20%. So again, I think it's important to start nibbling. Don't go all in. But these are definitely names, go towards the best of breed that have been crushed and looking for a snapback bounce at some point.
Okay, really interesting points there. Thank you for that. And so you mentioned inflation. I want to check in with you about inflation. We do have the Fed finally now seeming to be taking a stand against it, but we know that no matter what they do, it won't be an immediate reaction. So for you, when you look at the outlook, how long are we going to be living with inflation?
So, and if we look at inflation and the gauge of inflation, meaning, 2% or sub 2%, which is what we were living with prior to the last year and a half, my guess is 5 to 10 years. And I know that's scary and I know that's horrible, but there's no way that the Fed can put that genie back in the bottle when you have wages going up as much as they are, right? So if you think about the way a company works is, all of a sudden they have to hire people at, $25 an hour that they were paying $15 an hour. They can't all of a sudden turn around and raise the price of a widget and double that to offset the rise in cost. So they're going to do it over a course of many years where they're going to raise prices, let's say 10% per year, and that's going to keep inflation relatively high. Now, having said that, I don't think we're going to get, it's not going to be like we're going to have 10% inflation every single year for 10 years. I think more so it's going to be 8 to 10% for a year to 2 years. Then it's going to start coming down to 5% and kind of get sticky at around 5%. And the problem with that for the Fed is that it's still too high for the Fed to print a lot of money. So this is my biggest concern about what could happen is that if the economy starts to really stutter and starts to, trip and get into a recession, and you still have inflation, let's say at 5 or 6%, how does the Fed come out and print, trillions of dollars again with inflation at those levels? And I don't think they can. And so it really puts them in a bind about, okay, well, what can they do? Yes, they're raising interest rates so they can lower those interest rates. But again, the printing of money has really been what's gotten us out of these recessions or these downshifts in the past. And that's going to be really tough. And it's not going to be pretty, I fear.
Okay, so let's now check in on gold. We always like to see what's going on there. As you were just mentioning, it's covered a pretty big range in the last week or so. We were almost up at 2,000. I believe now as we're talking, it's more like 1,900. Yeah. So what are you seeing there? Do you see support at this 1,900 level?
Yeah, so support, there is a little bit of minor support at 1900 here, and I'll put a trend line on so we can see these little low pivots right here. If we draw a trend line right there, it kind of meshes right with that level. My fear is that I do think you still have a little bit more downside in gold. I think that this level will give way, but this is going to be like the best buying opportunity. So if you were someone, and again, before we broke out, so you can see this clear breakout that occurred back in February. If you didn't want to buy it before the breakout and then it ran up too much before you to chase it, you're going to get another opportunity. Likely, you're going to see a move back to like 1850 to 1825. And I think that is your spot. That is your spot where it's a retrace to the breakout trend line. You also have this kind of area right in here, right around 1850. And yes, I do think this is going to go much higher. I've talked about comparing the time frame that we're into the 1970s and the movement in gold there, where it went from $100 an ounce to $900 an ounce. And I think that is your great opportunity. So for me, I'm looking to accumulate more when it comes back to 1850 to 1825.
Yeah, and we have gone over your long-term expectations for gold. It's good to know that that is still solid. I wondered if we could take a look at the commodities sector as a whole, taking a step back. I think one headline I saw today was the World Bank saying we should expect high prices for commodities through to 2024. I wondered if that's something that you're seeing in the charts as well, if we look at that massive sector of commodities.
Yeah, so I do think that is generally true. I think we have to be aware that, certain metals are used in manufacturing and industrial, ways. So I think that it's not as simple to just say, oh, all metals are equal, right? So you have the gold, which is a perfect inflation hedge that should do very, very well. Generally, it's not ridiculously volatile. Then you have silver, which is partially industrial, partially a store of safety. That's obviously more volatile, both on the upside and the downside. And then you have things like platinum, palladium as well. So I think again, the gold is the pure play, but I do advise, I would definitely suggest being diversified with some of those other metals as well, and kind of diversifying out within the range, just so you're not all in. You never want to be all in on any one thing. Generally I say, never more than 10% of your portfolio in any one position. And I think that's very, very true, even when you look at the metals.
Right. And if you were going to diversify in the metals, say beyond gold and silver, where would you be looking?
Yeah, so I do think that platinum, palladium, platinum, interesting enough, and I'll show the chart here. Let me just bring it up. But platinum has actually been hammered quite a bit recently. And let's jump into that chart. So we can see platinum's come way back in here. And let me just zoom out a little bit. So we can see, again, platinum all the way down here. There's a lot of support just above 900. And if it gets below 900, there's more support around 850. So, anywhere between 850 and 900, I think makes a lot of sense. If you look at the chart here and we put in a trend line, the trend line I'm watching for now is this one right here. And in tune with that, you kind of have a parallel line right down here. So notice the 900 to the 850 level is kind of right on top of this trend line down here. And again, you're trading in this sideways consolidation pattern. Now, this pattern from this low up here and this consolidation is a bull flag, or in spirit of bull flag pattern. So, buy it kind of in the lower range. And then I would expect at some point for it to at least test the high end, maybe even break out to the upside. I also think, keep an eye on, I don't think uranium, let me look at URNM here. I don't think uranium's quite ready to be bought yet. But I do think that if it comes down in this range, this $50 level on the uranium miners ETF, I do think that gets interesting there as well. So there are some opportunities. And again, diversification, I think, is the best way to go about it, just so that you kind of hedge your bets. You never again want to be all in on anything.